most of this year I've been saying that I think gold, although I've admittedly been saying the gold stocks are very cheap, no question there, but I've been saying that I think it's going to be, well into the end of this year or beginning of next year before we really see gold move up significantly. And that's because people will buy gold when they believe or sense that the Federal Reserve has lost control of inflation. But when we start to see inflation numbers move back up again, and the Fed really unable because of the slowing economy and the rising debt service of the federal government, unable to increase rates, that's when gold will turn. So to say that again more succinctly.
Since surpassing the crucial threshold of $2,000 per ounce in early May, gold prices have declined by nearly 12% as hawkish rhetoric from the Fed has pushed bond yields to their highest level in 16 years. Gold prices edged lower for a ninth straight session on Thursday, driven by U.S. data indicating tight labor market conditions, which raised concerns about the Federal Reserve maintaining higher interest rates for some time. Adrian Day believes that gold stocks are undervalued but foresees a gradual uptick in gold prices. Despite the Federal Reserve and global central banks implementing rigorous tightening measures in the past year, gold's value has notably risen, climbing from around $1,600 to nearly $1,900 per ounce. In response to persistent inflation above target, the Fed has raised its key lending rate 11 times since March 2022, reaching a 22-year high. Despite these efforts, inflation remains stubbornly high, prompting most Fed officials to anticipate another rate hike this year. Adrian emphasizes that the Federal Reserve has been tightening monetary policy more aggressively than expected by many in the gold market, raising expectations of an upcoming rate increase. Central banks added a substantial 1,136 tons of gold, worth approximately $70 billion to their stockpiles in 2022, marking the highest annual increase in central bank gold holdings since records began in 1950, as reported by the World Gold Council. Unlike individual investors or ETFs, central banks tend to be relatively insensitive to short-term price fluctuations. However, Adrian expresses concern that only a few banks carried out the majority of central bank buying. Therefore, a pause in their buying could significantly impact gold prices. We will now bring you clips from Adrian Day's interview with Palisades Gold Radio. But before we do, if you want more videos like this, hit the subscribe button and turn on the notification bell for more updates. Thank you and enjoy the video.
Gold investors, in my experience, always want more. They are never satisfied. They're never satisfied. Look, a year ago, gold was just barely over 1,600. A year ago, today, 1620. We're now almost 1900. So that's a pretty darn good return in 1 year in the face of the most aggressive tightening that we have ever seen by the Federal Reserve, the most aggressive pace of tightening that we've ever seen by the Federal Reserve, and tightening around the world. And not just tightening that has taken place, but the prospects for future tightening remain in the US and around the world. So in the face of that, gold to go up from 1,600 to 1,900, I think is pretty powerful, But again, gold investors never seem to be satisfied. Now, I think what has happened in the last few months is you've had the Federal Reserve continue to tighten more than most people in the gold market particularly thought. Remember 6 months ago, all the talk was about a pause and a pivot and everything else. But instead, and the gold market believed that more than the stock market even, but the Fed has continued to tighten. They may tighten again, another rate hike this year. I think that's likely. I've said that, for the last few months. I think we're going to see another rate hike this month. And then again, let's not forget, as Peter Bookvar keeps reminding us, higher for longer, even if they don't increase rates, but higher for longer is its own form of tightening. So not only have we had these dramatic increases, and they've gone on longer than the gold market was expecting, but the Fed is trying to tell us, trying to convince us that they're going to remain higher for longer. The central banks have been the main supporter. Central bank buying has been the main supporter of the gold price over the last 12 months, really, since last October. If you look at ETFs, for example, gold ETFs, they've had outflows. Other than a couple of months at the beginning of this year, they've had ongoing and fairly significant outflows all year. So gold has been supported primarily by the central banks. The central banks tend to be price insensitive. When they make a decision to allocate 5% or 10% of their reserves to gold, they're looking at that not as a trade, but as a long-term position. And so they tend to be relatively price sensitive. Now, having said that, one of the big concerns that I've expressed, when you have very strong demand for 1 ounce gold coins from around the world, you've got millions and millions of people buying those coins. When you have ETF inflows, you've got, again, millions of people buying ETFs. When you're looking at the central banks over the last 12 months, the vast majority of the buying has been, a handful of banks, 4 or 5 banks. So you only need 4 or 5 banks to decide to pause their buying for a short period of time for it to have a meaningful impact on the gold price. You don't need millions of people to change their mind. You just need a handful of people to change their mind. And I think that's one of the big risks in gold that remains. But I mean, fundamentally, on a longer term basis, I think that the central banks are going to continue accumulating gold for the same reason. They're reducing their exposure to the dollar, and they want a global asset.
The BRICS nations are making significant strides towards reshaping the global financial landscape, which is constantly evolving. For example, the U.S. is weaponizing the dollar-denominated global financial system against Russia. The BRICS nations have discussed creating a common BRICS currency to challenge the dollar. However, Adrian expects the BRICS to form ad hoc relationships rather than a strong formal bloc. Adrian observes the decline in the U.S. dollar's share of the central bank's foreign currency reserves over the past few decades. Earlier this year, before the rebound, spot currency traders made significant profits by betting that the dollar would decline from the 20-year highs it reached in 2022. While the dollar still dominates world trade, many nations, including China and Russia, are actively working to diminish its influence. In the late 1970s, the U.S. dollar's share of global reserve currencies stood at 85%. However, by the end of 2022, that share had fallen to just 58.4%. As indicated by the International Monetary Fund's currency composition of official foreign exchange reserves data. This downward trend is expected to persist, primarily due to concerns about the weaponization of the U.S. dollar. Let's get back to the interview.
So I think there was a lot of naive optimism about the BRIC currency and the conference in South Africa. I'll say a couple of other things, if I may. Remember, the countries that are joining the BRICS, and there's a lot of countries that want to join, don't have an awful lot in common other than their distrust or dislike of the US. But they don't really have an awful lot in common at the moment. So it's going to be a very ad hoc, I think, a series of ad hoc relationships rather than a very strong formal bloc to challenge the US. And if you look at the dollar and the reserves, that's been a long slide. 30 years ago, the dollar represented almost 80% of all central banks' foreign currency reserves. And that's now down to barely 50%. That is a huge decline in something that typically moves very, very slowly. Central banks are not traders or speculators. They move very, very slowly. So to go from 80%, I think 30 years ago it was like 75%, to now 50%, is a very, very significant move. in a relatively short period of time. I think that's going to continue. It's going to continue because of, the weaponization of the dollar. You don't have to be Russia or even China or North Korea to not want to be too exposed to the US dollar at the moment. Mm-hmm. Remember the US government sanctioned Bank Paribas in France. They sanctioned Banco Santander in Spain. And what was Banco Santander's crime? Their crime was they made a loan to a Spanish construction company that built a hotel in Cuba, not against Spanish law, not against EU law, and yet the US, because they had the power to do it, because the money went through the SWIFT system, thought it was their right to sanction a foreign government, a foreign country, a foreign bank, doing something perfectly legal under their own laws. So anyway, that's the one side. The trading side, I think we're going to start, well, we already are. We're seeing a series of ad hoc things, most of them relatively small at the moment, but the big one, of course, is China and Saudi Arabia. So Saudi Arabia selling oil to China using yuan instead of the dollar. That's the big one. Now, in terms of trade, most trade is still in the dollar. Most trade around the world.
Gold prices are expected to remain under pressure in the short term as the Federal Reserve raises interest rates and withdraws liquidity from the market. What are your thoughts on the recent fluctuations in gold prices and the impact of the Federal Reserve's policies on the market? Share your observations in the comments section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks for watching.